Hello. Welcome to the IRE.IQ Quarterly Fundraising Report review. I'd like to thank you for joining us for a look at closed-end real estate fundraising activity as tracked by our IRE.IQ database. I'll be sharing some trends and data covered by our Q1 2026 IRE.IQ Fundraising Report, which was published on Thursday, May 7th. Today, I'll be joined by a pair of industry experts to discuss the broader trends affecting real estate fundraising and where the market might be headed. I will share a brief slide presentation with data and charts from the IRE.IQ fundraising report, and then we will have a broader conversation about fundraising. We will also be answering questions from the audience through the Q&A feature. You should be able to access it at the bottom of the screen. If you do not see the Q&A button, it will be under the More section. All the data discussed in the program comes from our IRE.IQ database. IRE.IQ includes information on organizations, investment programs, and industry contacts, and it has tracked more than 6,000 global institutional real estate investment programs, more than 1,100 of which are actively in the market now and seeking to raise a combined total of more than $500 billion from institutional investors. Our publication sponsors receive access to IRE.IQ as part of their benefits package. If you are not a sponsor and are interested in using IRE.IQ, you can subscribe by clicking on the IRE.IQ logo on our website. I'd like to welcome our panelists, Maria Surina of Cambridge Associates and Rich Hill of Principal Asset Management. Thank you both for joining us. Hope you're having a great day. Why don't we get started with each of you giving sort of a brief overview of your role and where you sit in the fundraising ecosystem and the perspective that gives you on the market. And Maria, I'm going to go ahead and start with you.
Thank you, Loretta. It's a pleasure to be here today. So a quick introduction. I'm a member of the Cambridge Associates Real Assets team, where my focus is on sourcing global real assets investment opportunities and constructing portfolio for our clients. Cambridge Associates is a global investment firm with over 600 billion of assets under advisory, and we partner with our clients that include a broad range of institutional partners like pensions, insurance, foundations, endowments, private family offices, and build custom portfolios for them. And that gives me a very unique perspective on the fundraising ecosystem because I do work with institutional clients of mine and also maintain very long-standing relationships with a wide range of managers, many of whom we've known for decades. On the real assets side specifically, we track roughly 6,500 funds in our database globally. So you can imagine I spend a lot of time meeting managers, listening to their presentations, understanding how in this current fundraising environment, they're looking to evolve with their strategy, adopt to the market environment, and happy to share some of the intel with all of you during the discussion today. Thank you.
Fantastic. And Rich, maybe a little bit about yourself.
Yeah, thanks for having me, Loretta. My name is Richard Hill. Most people call me Rich. I'm Global Head of Real Estate Strategy and Research at Principal Asset Management. For those that might not be familiar with Principal Asset Management, we manage a little bit less than $600 billion, of which almost $108 billion is in real estate. So about 19% of our global AUM is in real estate. I hope oversee our investment capabilities across the four quadrants of real estate, public and private, equity, and debt. We break down those four quadrants as around $57 billion of private equity, 22.5 of private credit, $20 billion of private REITs, and the remainder is in commercial mortgage-backed securities. So what is my role in the fundraising ecosystem? First, the research team is not part of the marketing department at Principal Asset Management. We are an independent, objective team within Principal Asset Management. I take my roles and responsibilities on the strategy side of the equation of my title. Very important. I think they are very important. So there are times in which research brings strategy to the portfolio management team and says, hey, look, we think this could raise capital. There's other times in which the portfolio management team comes to us and says, we have an idea. Does this pass the sniff test? But I am not out there marketing and raising funds. I do travel extensively. I'm objective, data-driven. I help answer questions. Sometimes those questions are about our funds. Sometimes they're not about our funds. So long way of saying I'm at sort of all parts of the ecosystem, even though I'm not specifically out there raising funds on behalf of Principal Asset Management.
Thank you. Thank you both. I am going to start our slide program just now. And I just want to mention as we get started that what we're looking at here is closed-end real estate fundraising specifically. And we're looking at closed-end funds investing in direct properties or real estate debt. For this current report, we are sharing data on funds with a final close between January 1st and March 31st. One thing that I do always try to emphasize is that this is a snapshot in time. It is possible additional funds have closed but haven't announced yet. Our IRE.IQ team learns about fund closings continuously as the year goes by, and we update our data accordingly. But I do think that the overall trends are still useful to indicate what's happening in the market, give some guidance to where investors are headed. And just one more reminder for the audience, we are taking Q&A. So use the Q&A feature. We will be able to take questions. I have on the line with me my IRE.IQ colleague, Nico Pepas. He'll be able to answer any of your more technical questions about the data set in writing, whereas I'll pose some of the broader questions to our panelists. And so, just to sort of set the table here, we tracked 26 funds that held a final close in the first quarter. And in aggregate, those funds raised $27 billion. In 2025, we saw 136 funds hold a final close with aggregate equity of 158 billion. And that was up 72%, I think, the last time I calculated it, from the 92 billion that was raised in 2024. Like the difference between 24 and 25 was quite stark in our data. Average time to close for these funds, because I know that was a question that you asked when we were prepping for this, Rich. Average time to close in Q1 26, 20 months, with a median of 18 months, so a year and a half, a range of 4 months to 41 months. So, there are some very different experiences out there in the marketplace. All of that said, how does this sort of reflect back or match what you're seeing in the market? And I will go ahead and start with you, Rich, and then I'll go to you, Maria.
Sure. Well, look, there's obviously strong fundraising activity in 2025. And you note that you're tracking closes rather than, or final closes rather than closes along the way. I'll have Maria talk to that in a second, because I think she has some really good insights on that. But I'll talk about what's going on in 2026. First, the world is unusually complex. I think it would be extremely naive for me to say anything other than that. There are a confluence of factors that our investors are dealing with. We were at our institutional client conference last week. And I would say investors are becoming more deliberate, but not pulling back. The differentiating factor for us is that if you have a good idea that is going to produce attractive returns, I think investors are willing to come to the table and listen to that. So I don't want to give you the impression that it's easy to raise funds right now, because it's not at all. You have to bring something that's differentiated. You have to bring something that is going to meet the return objectives, and that can vary from investor to investor. But if you do that, I think there is a willingness to listen right now across the risk spectrum: open-end, closed-end, core plus, value add, opportunistic. It really depends upon what the investors' objectives are. So I can go a lot deeper on that, but maybe I can pause there, see what questions you have, and kick it over to Maria as well, because I think the way Cambridge looks at it is pretty interesting.
I will take from here. Yes, happy to do that. Loretta, directionally, the trends that you have shared, I agree, it's consistent with how we are seeing it in the market. It's fair to say also, Rich, that sentiment for investors is improving, and clearly fundraising remained well below 2021 and 2022 peak years. Activity picked up in 2025, and that momentum has continued throughout 2026. Now, when we look at 2025, we estimate that about 140 funds were launched. targeting nearly 140 billion, 140 billion, 140 funds. Now, it doesn't mean that all this capital will ultimately be raised and final close will take time to get to, but the volume for the launch of the funds has certainly picked up and about 35% higher than what it was in 2024. So you probably recognize that my approach and methodology here is somewhat different. I focus on the first close and the launch of the fund. You look at the actual dollars committed. That says, I agree that investors still cautious. Capital continues to concentrate with larger, more established managers. And I will bring something in addition to just the overall market environment and geopolitical situation. I would say that inflation has certainly resurfaced as the key topic again. And we all see that in the April numbers that came out ahead of expectations, driven in part, obviously, by the rising energy prices. And so that has just renewed the attention, I think, to our asset class, real assets that can play some of the inflation hedging role. And while it's a bigger topic and not for today's discussion, I would just flag that despite some of the challenging performance in the sector, I think the evolving market draws more attention to real assets in general. With that backdrop, back to you.
Thank you. One of the things that has been coming up a lot, and we do regular virtual roundtables with people in the industry. We're always trying to talk to people to hear what they're saying. And, one of the challenges that real estate has faced in its fundraising over the past couple of years it's been the performance. If you talk to LPs, one of their concerns has been performance. 2021, 2022 were record-breaking years as far as transaction volume and capital raising. This chart doesn't go back that far, but anyone who has been, following these reports over the years can go back and look at those earlier years. Okay, we're 3 to 4 years later. Maria, how are those vintages performing?
If you look at 2021 and 2022, I would say they're still fairly early in their life cycles, and some of the funds may still be in their investment periods. So it's probably too soon to draw any firm conclusions. But if I were to look at the Cambridge benchmark and look at the returns as of third quarter 2025, which is the latest I have available, median IRRs for those vintages are not very exciting numbers yet. It's about 4.7% for 2021 vintage and 5.5, again, median net IRR for 2022 vintage. Now, I think it's more helpful to look beyond those years and look at the more seasoned vintages, say 2017, and look at how those funds were impacted throughout this market reset. And I would say that the numbers and the reduction in performances have been pretty eye-opening. I'll give you this quick example. If you look at 2017 vintage, if you look at the performance for that vintage as of September 2022, that vintage has posted about 14% net IRR at the time. Fast forward 3 years, the same 2017 vintage year, I'm now looking at the performance for that vintage as of 9/30/2025. Does anybody want to take a guess what that net IRR looks like today? 9%. So we're talking about at least 500 plus basis points of performance erosion. And that continues to be the case for all subsequent vintages. It varies vintage by vintage, and the magnitude varies, but we're talking about roughly between 600 and 900 points of performance reduction.
Rich, you look like you want to weigh in here.
I'll just add a couple things. I think Maria nailed it with what's happening with the 2021, 2022 vintages from a headline perspective. I struggle with headline returns when you're talking about closed-end opportunistic and value-add funds, and frankly, even open-ended funds. If you go back and you can look at a lot of studies, there's studies that suggest value-add and opportunistic fund vehicles by vintage underperform core. That doesn't really make a lot of sense. But my point is, I think sometimes when we think about headline vintage returns, we're talking about the law of averages. And in good vintages, there are funds that don't produce good returns. And in challenging vintages, there's funds that do produce good returns. My point is, if you look at what's actually happening with the dispersion of returns, the top quartile of funds right now in the 2021 and 2022 vintages are putting up high single-digit to low double-digit returns. Maybe those still come down, but some top-tier managers are finding ways to navigate through this environment. To be clear, that dispersion of returns that I talked to you about is present across all vintages to various different degrees. I can go back and look at some of the best vintages, and sometimes the top tier does 20% plus, and the bottom tier does closer to zero. So yes, it is hard to manage funds as you go out the risk spectrum. So I just always argue to investors, make sure you're looking at the dispersion of returns.
Right. And I guess part of why I bring this up is maybe to sort of set some sort of boundaries over how LPs are sort of feeling about real estate as we come into this next fundraising period, especially one that I'm hearing from a lot of people that's very optimistic about the 26 vintage as far as performance for these funds. So, that there's a lot of things that people are maybe, people who are going to be investing in real estate are pretty excited about investing this vintage, but you have this overhang of disappointment maybe. Does that make sense, Rich?
Yeah, it resonates with me. I won't beat around the bush. The last several years have been a difficult environment to be a manager of commercial real estate. Why is 2021 vintage not look so great? Well, you bought at peak valuations at historically low interest rates. So what's happened over the past several years is the market's actually acted very rationally. Fundamentals have held in pretty well, but it's been dealing with a higher interest rate environment and higher financing cost environment, and valuations had to go down. But to your point about how investors are feeling a little bit more optimistic, we think this cycle is almost playing out in textbook fashion. And so what do I mean by that? Well, listed REITs trough first. Listed REITs troughed in 2023. They're now up more than 55% from that trough. Private valuations troughed 12 to 24 months later. Private valuations have been in a sustained recovery in the United States for about 7 quarters now. And then distress is a lagging indicator. So when you start to weave that narrative together, it's not surprising to me that people would be pretty excited about this vintage. You go back and you look at historical vintages, the best returns occur in the aftermath of challenging environments. You look in the early 1990s, post 2000, 2001, and then post the GFC, you can get into the high single-digit returns from a median perspective. So I get why investors are excited. I'll make one more point and then I'll stop. But for a long time, past 2 years, the market's been saying, investors have been saying, well, does commercial real estate really work in our portfolio? I get it, right? Returns have been drawing down while other risk assets have been at historical highs. I think some of the froth or the rose coming off the bloom, if you will, for things like private equity and private credit, that's great for commercial real estate because it starts to say, well, commercial real estate's already gone through a downturn, other asset classes haven't. It wasn't the exception, it was just a leading indicator. So I understand why investors would start to say, hey, look, maybe I'm supposed to look at commercial real estate with a new lens.
I'm gonna jump ahead to the next slide. This is a debt fundraising, real estate debt as a portion of the overall market, and these are pure play debt funds. There are also some funds that invest in both debt and equity in our share. It can be a little bit up and down. There was only one debt fund that held a final close in the first quarter. But taking a step back from just a single quarter performance, what are your thoughts on real estate debt fundraising in the current environment and real estate debt perhaps in comparison to private credit? Maria, maybe I'll start with you and then I'll go to Rich.
Sure. I would say the environment remains constructive for real estate debt fundraising because at the moment when traditional lenders have pulled back from commercial real estate, that created an opportunity for alternative lenders to come in. Obviously, we have seen some reset back to traditional lenders lending to real estate, but we still, I think, have plenty of opportunities for alternative lenders to fill in the gap. And we know that interest rate environment remains elevated and likely will stay so. So I think more to say for real estate debt funds being able to play a role in the portfolio. I do want to obviously be cautious here because I don't want to generalize. Some of the clients I work with always had an allocation to uh, real assets credit, and they just continue to build it out. Maybe they can increase it given some of that tactical movement. But some of the clients that always thought about real assets and real estate as the growth engine won't necessarily change that philosophy and say, you know what, I no longer want real estate to be my growth engine. I want that to be my yield oriented instrument in the portfolio. I haven't seen that. So I think you have to take, yes, we definitely have a lot of debt funds coming into the market, but it doesn't necessarily mean that all LPs are reorienting themselves around the role that real estate plays in the portfolio. And ultimately it all boils down to, when I evaluate a real estate debt manager, is how long they've been around. Is this sort of just a tactical desire to launch a strategy, or they've been investing in the debt space for a long time, have a track record, know how to work out complex deals? And lastly, I guess just again, also the return objectives. Obviously, you can see attractive IRRs from real estate debt funds, and yields is there, of course, but not always the multiple. And multiple, you can argue, still equity funds will presumably get you to a higher multiple outcome.
Rich,
Yeah,
anything to add?
Maria made a lot of really good points, and I can get on my soapbox about commercial real estate credit. So bear with me for a second. But first, we're a firm believer that all four quadrants have a home within portfolios. When someone says, "Do I like equity versus debt?" I tell them, "You're making me choose between my four kids. I like them for different reasons." So that's point number one. Point number two is that private CRE credit is still our top recommendation across the four quadrants. Why is that the case? It's really for two reasons. First, risk-adjusted returns. When you're originating a new loan in a new debt vehicle, you have conservative LTVs on valuations that have already reset lower. Think about, if you're originating a 60% LTV on a valuation that's already fallen 20%, you have to have those valuations fall another 40% before that loan takes a loss. So risk-adjusted returns are really compelling. But investors are starting to recognize something else with private CRE credit. You actually own a real asset. The valuation does not go away tomorrow. And you've seen in the private credit space some loans being marked from par to zero, literally, overnight. And I'm not being facetious about that. So you really own something. But Maria made a really good point. We think to be a top tier private CRE credit manager, you not only have to know how to deploy capital, but you need to know how to service that. And if things go wrong in a loan book, you need to know how to foreclose on it and ultimately own it. So there's been a lot of new entrants into the CRE debt space. I'm not sure all of them have expertise to do that. The final point I would make on this is volatility adjusted returns are really, really attractive in the CRE debt space because they're all income driven. If you go back and you look at some like the NCREIF indices that they have out now, there has not been a single quarter since 2014 with negative total returns. And that includes COVID and that includes the drawdown. So when you think about Sharpe ratios, if you will, to be a little bit wonky, they screen really attractively. What does that all mean? Despite all the fundraising we've seen in the CRE debt space, and we've seen a lot, I do think investors are beginning to look at CRE debt with a new perspective and say, does it provide a diversifier within my portfolio? And does it do something different than private credit or private equity? And does it do something different than even private CRE equity? So a lot there to unpack, but I think it's an interesting asset class from a diversification perspective. And I think the volatility adjusted returns are probably significantly undervalued.
Just real quick, want to touch on the average fund size. It was nearly 1.1 billion with a median of 875 million in Q1. I think nearly half of the funds that we tracked holding a final close were 1 billion or more, and there were 3 that raised more than 2 billion. What role, and I would say none of them really hit that super mega fund space that does happen every few quarters we'll get one of those. But what are your thoughts about sort of the middle market versus the mega fund in this space? Why don't I start with you, Maria, on that?
Sure. If we have expanded your timeline here, Loretta, you would see that the average fund size 25 years ago was 300 in change. So we certainly observe a continuous increase. Yes, there is some volatility. Yes, we do have mega cap funds come in and they lift that average, but for the most part, averages continue to rise. As to the role, of course, we can talk about the funds that are mega funds, and they clearly capture a meaningful portion of the market. Mid and large tier managers, which is kind of billion plus, continuously grab higher percent of the LP's capital. I would say on average, historical is about 40-ish%. The 1 billion plus funds have captured historically. But I also think that we shouldn't forget about the smaller emerging manager pool of funds that disproportionately get a smaller percent of the capital, and sometimes it's driven by the restriction of an LP to write a check to a small manager. Obviously, it's an emerging manager. It comes with an additional set of underwriting requirements, and that is obviously a part of it. But I do think that when we look at the performance by fund size, I would conclude that fund size does matter. Smaller funds obviously produce a larger band of outcomes, let's put it this way. But if you can hit that first and top quartile manager, man, you're going to get really strong outperformance. If you lean towards more this mid, larger cap size, you can argue that you certainly get high quality institutional platforms. Your downside is protected, but your upside may be limited as well.
So this is a major topic of conversations when I advise our clients right now. I think that so we have a thesis that this is a cycle of selectivity where there is significant dispersion in returns across property types, markets, and fund vehicles. If you believe that, that means you should probably have more targeted strategies going forward. So the question becomes: do you have a targeted strategy with an expert, or do you have a targeted strategy with a large manager that is bringing a targeted strategy to market? I think you can go both ways on it. I'm biased because I work for a large manager that brings target strategies to market. And we think that works really well because, look, we have the ability to bring all property types to market. We don't want to bring an office strategy to market or an industrial strategy to market just to pick on two property types. We don't have to. If we see better relative value in data centers or living or retail, we can do that. Some investors think that's really valuable because we have the ability to see around the corner. Other investors say in this market, I'd want to be with an expert that specializes in affordable rental housing. Again, just using a topic. I think it depends upon the investor's mandates and what they're trying to achieve. If an investor thinks that they can be the asset allocator and pick between the various different property types and build their own portfolio, I could have an appreciation why they want an expert manager. But a lot of managers, a lot of investors aren't like that and want us to be an advisor and a partner with them and say, hey, look, this was out of favor previously, but you're underweight to it and it's beginning to turn the corner. So I lean towards a bigger manager bringing target strategies to market. And I think what Maria said is if you can have an established track record with a manager that is always producing top half of top quartile returns, you're going to do really, really well.
I would just add, Rich, and agree with your observations. We definitely observe an increase in sector-focused strategies. Diversified funds continue to dominate. They're still between 55 and 60%, let's say on average, over the fundraising activity. But certainly there is this pivot towards more sector-focused strategies. Now, you're right. They can come in the form of just one firm, one strategy, or it can be a very established platform launching dedicated funds. Again, it all goes back to the manager selection, and ultimately, you want to make sure that you're getting the best risk-adjusted return. And do you have a strong property level outcome as well as the net fund level outcome? What is the gross to net leakage? Are we paying double fee promote or not? I think it's all subject to a bigger portfolio construction debate. But I would certainly agree that the trends show that there's definitely a rise in more sector-focused offerings in the market.
Loretta, I'm biting my tongue to not moderate your panel. But please, can we talk about open-ended core and core plus funds at some point?
Yes, yes. In fact, I have a moment in which to do that in two slides. Two slides we will get into it, and we can get into it. And I will encourage the audience to queue up some questions maybe for that segment as well. Um, just really quickly, let's touch on the regional market focus. This is over the past 12 months. This is where capital has been going to, so funds aimed at these regions. In the Q1, we saw 72% of the capital raised by funds that were planning to invest in the Americas. We saw 15% raised by funds looking at EMEA. I know that because we're tracking on close, this might be a little bit of a lagging picture. Maria, looking at fund launching, do you see maybe increased interest outside of the US than this data would show since you're looking a little bit more forward looking?
I would say generally North America captures, at least in 2025, it captured about 60% of this fundraising activity in terms of the target regions, and the balance is obviously EMEA and Asia Pacific and global funds. I haven't yet seen a drastic change in that allocation. However, I think a bigger question is how do clients think about the allocations going forward? And we can talk about sort of the perception of the investors outside of the US and how they think about our market, and do they want to maybe lean more heavily into their local markets or find diversification. Likewise, even outside of the geopolitical tensions today in the US, investors last year would I have conversations saying, we haven't looked into Europe in a long time. Obviously, performance has been challenged by currency situation and some other headwinds in some isolated markets, and I think regulatory risk or challenge is always something to think about when you invest outside of your country. But Europe all of a sudden looked very attractive because of the similar trends in real estate, but at the same time, perhaps repricing that happened ahead of the US and more favorable interest rate environment. So it's not just one of the reasons, but I would think that we're unlikely, I would not expect the decline in fundraising activity or target regions going forward. I would think it either will stay within historical averages or perhaps go a little bit up.
Rich,
Yeah,
anything to add here?
yeah, look, as a headline statement, we believe commercial real estate portfolios will become more globally diversified, not less globally diversified. So when I see something like 75% of fundraising was in the US and Canada, that doesn't really surprise me too much because US and Canada has 75% of total global real estate values. So we would argue the US is too big to ignore. Whether it's 50%, 60%, or 75%, it's still going to be the majority of fundraising activity. I do think the bar has risen a little bit to invest in the United States. There's nothing wrong with that. Why has the bar risen to invest in the United States? To me, it comes back down to a really simple question or a simple statement. European investors just feel like they have to hedge the US dollar. And hedging the US dollar costs a sum of money. Last year at its peak, it was around 280 basis points. Today, it's 130 to 150 basis points. So that takes away from your returns. As a result, more and more European investors are looking at higher return strategies like core plus, value add, opportunistic strategies that just have more net operating income growth to drive returns. I do think, though, Europe is becoming more interesting to investors, partially because Europe is actually leading the commercial real estate recovery relative to the United States. But when we speak to US investors, Middle Eastern investors, Asian investors, I don't think they're looking at Europe as a beta asset class. I think it's very much of an alpha asset class where they're looking at target strategies, things like data centers or logistics. I don't think across the board. Now, I do think Europe's going to see more value add strategies, which is interesting. The final point I would make on this is I think a lot of investors are underweight to Asia Pacific. 10% sounds like the right number to me, but that's way lower than Asia's contribution to total commercial real estate valuations. The problem with Asia Pacific is it's hard to invest in the region. It's not really a region. It's a collection of countries that are in close proximity to each other, but have very little economic correlations. So, you have things like Korea, Singapore, Australia, Japan. Those are the most investable strategies, but it's not really a core market. So I don't know. I think you're going to see Asia go up. I think you're going to see Europe go up. I think you're going to see U.S. remain relatively stable from the numbers Maria mentioned. But my big takeaway is it's going to become more globally diversified, but it's going to be targeted strategies that deliver the returns investors need in this environment, and they'll be agnostic about what region that is.
Talking about investment style and strategy. Here's the 12-month totals for strategy. And one question that we often get, and I will go to our Q&As in a moment, but one question we often get about returns here is, what do you mean by not disclosed, and how do you describe funds? So we are very much, there's a lot of different ways that you could categorize investment style. One thing that we actually do is in some ways the simplest, and we rely on what the fund is marketing itself as. In a lot of ways, these are marketing terms. And so, if a fund says we're a core fund, we put it into our core bucket. If a fund doesn't disclose a strategy, we put it into a not disclosed bucket. A big proportion, I will say, of the funds in that not disclosed bucket are debt funds, because they don't really think of themselves as necessarily having the same sort of strategies and styles. So that's just some backdrop for the audience and for you. But one thing that we don't really track in this data is open-end funds. This is closed-end fundraising. These are funds holding a final close. Rich, you wanted to throw out open-end core. What are you seeing there, and what's the outlook?
Yeah, look, open-ended core funds in the United States and Europe, which are loosely known as Odyssey funds, ODCE. There's 25 Odyssey funds in the United States as an example. And some of the consultants will say anything that's not an Odyssey fund is not a core fund, and it's core plus. I'm not sure I agree with that, because there's many open-ended funds that are not an Odyssey that are not core plus. But the point I would make to you is I think there's a wide dispersion of how we're thinking about core funds. I'll just give you a couple different examples. Core fund returns headline were really modest in 2025 at 3.9%. But core funds actually have a lot of dispersion in returns. The top quartile of US Odyssey funds generated 6, the second quartile did 5, the third quartile did 4, and the bottom quartile was flat. So what we see happening in the open-ended core fund space right now is a smaller concentration of managers grabbing more AUM from competitors. And I'll tell you from our perspective, we've moved from outflows into inflows for both our core and core plus funds. That's pretty interesting. Why are investors looking at it? Well, it comes back down to you just want stable, income-driven total returns. And that's pretty attractive in this environment. Core returns don't work for everyone, but it works for some people. Core plus is really attractive. So I think the tide has turned in core open-ended core funds, especially if you manage through this downturn over the past several years the right way by clearing your queues, and you can be on the offensive right now and take advantage. But we're definitely seeing more inflows than outflows at this point in both our core and core plus funds.
Rich, I would argue it's kind of hard to choose a winner in the core fund universe, just given sort of the band of outcomes is relatively narrow, let's say, right? Because Odyssey posted 7% net return since inception, and yes, top quartile would do better and bottom not so much, but it's still, we're talking a relatively narrow band. And I think that's why it's very much impacted by things like, one fund decided to lean a little bit more into development, the other one had a little bit too much office, and that swings the outcomes relatively quickly. So looking at some data, I would say like 20 years ago, it was one fund and not everybody sort of retained their position in a consistent manner. But I do think that with Odyssey kind of reflecting on how we can think that universe of core funds can evolve is sort of that expanding into other alternative sectors, whether it's digital perhaps for some, like data centers, or leaning again more heavily into some of those let's put it, senior living, self-storage type of sectors, I think may provide that wider band of outcomes. And maybe that's where you find alpha and see higher dispersion of returns than what we historically observed.
So I'll just make two quick comments here, and this is a good back and forth. Sorry, Loretta, for again moderating your own panel. I agree with you that there's a lower dispersion of returns. And so when we think about this and we speak to consultants and investors, I actually think information ratios for open-ended core funds are really important. What do I mean by information ratios? You don't want to have outperformance relative to the index by being down 6 and up 10 one quarter to the other. You want to have predictable returns. So said another way, you want to make sure your outperformance isn't a random walk. And you're doing this predictably and consistently, which is really the power of income returns. On alternatives, we like alternatives as much as anyone else. I am a little bit concerned that open-ended core funds might just increase alternative exposure for the sake of alternative exposure. It's hard to get into alternative exposure. I think you need to do it for fundamental reasons, and if you do it for fundamental reasons, whether your alternative exposure is 10, 20, or 30%. It can drive alpha. But surprisingly, if you look at some of the data that we've looked at, and maybe it's different than yours, there's not a huge differentiation in alternative exposure between the bottom quartile and top quartile by headline number. So I think it's really a matter of do you have expertise managing these assets? And are you just doing it for an alpha grab that may or may not turn out?
And when exactly you entered that sector, right? Because at the end of the day, I looked at this analysis early on. A lot of funds have exposure to industrial and multifamily. I think what drove the difference is, did you buy that industrial 10 years ago or in 2021? You may end up with the same allocation, but your outcome will be very, very different. Loretta, I wanted to quickly comment on your slide here, just saying that we also similarly focus in our tracking on value add and opportunistic funds. And I would say, obviously, that can swing quarter over quarter. I would say that, yes, opportunistics, we see more opportunistic funds in general, but I can see with some of the early points we made about the need for liquidity and maybe a little bit of distribution, value add funds are meant to provide more of that ballast in terms of providing some cash flow back to investors throughout the fund life and not being all back-ended, as opportunistic funds tend to kind of obviously be focused more on realizations and sending capital at that time. So I can see maybe a bit of an increase in the value add fund fundraising activity driven by the investors' expectation for some of that DPI.
I'm gonna leave the takeaways up for our viewers, but I'm not gonna walk through them. You will anyone who signed up for this webinar will get a copy of these slides, so I don't feel the need to read them out right now. But I think taking a couple of steps back, what are you hearing from investors right now? I'll start with you, Rich. Do you think we're in the midst of a sentiment change in the real estate market, or was there a sentiment change recently that we're still experiencing? What are investors' biggest concerns right now?
Yeah, so I think we're in the midst of a sentiment change, but I want to be clear, that does not mean there's FOMO in the market. There's very little FOMO in the market because investors don't feel like they're going to miss out right now. I do think that there's beginning to be a shift back to real assets, income-driven assets, things that you can touch and feel. I cover all 4 quadrants, so I'm going to comment on the listed REIT market for a second. We think the listed REIT market is both the ultimate leading indicator in both downturns and recoveries, and a sign of when sentiment is shifting. Through the first 4 months of the year, the U.S. listed REIT market was up 13% total returns gross, and real estate was the 4th best sector of the 11 S&P 500 sectors. That's a leading indicator that things are beginning to shift. It feels a little bit like the late 1990s into the early 2000s to us, where investors are beginning to recognize, hey, look, commercial real estate can be a diversifier in my portfolio. It does do something different. It does provide income returns. It does provide downside protection. I think all of those are good things. So to us, it's like the sentiment change is here. But I want to be clear, I would not be surprised in 10 years' time for 3 different investors to tell me 3 different things. I could see one investor saying, hey, I had a great experience in real estate and produced tremendous alpha because they picked the right funds. I could see another investor saying, it was just okay because I hugged the benchmark and my headline returns were okay. And I could see another investor saying, this wasn't so great. I picked the wrong funds and I underperformed. Guess what? That's how real estate works. And it's an exciting environment for us. So I would say there's a tremendous alpha opportunity. Sentiment is changing, but it's a cycle for selectivity where there's a significant dispersion of returns across property types, markets, and fund vehicles.
Maria?
Rich captured most of the points I would probably want to convey as well. I think there's definitely increase in desire to invest in the real asset space. I think there's still selectivity is there. There are no automatic re-ups. Everything can be sort of dismissed. I would say the bigger focus now is, it always has to be, but in an environment like now, you want to make sure that the manager can also drive operational improvement to the asset and can prove that they know how to execute on a business plan. And it's not just a great cap rate compression that has saved some not so great investments in before 2021 vintages. So I think that selectivity remains to be there, but I definitely, just reflecting on the conversations with clients thus far, I think there's come back to real assets, not broad, but definitely selectively.
I have a question from the audience, and I'm going to start with you, Maria, on it, and I'm going to frame it a little bit in that, one of the spaces, one of the big beneficiaries of some of the concerns that investors have had around commercial real estate in the last couple of years has been the infrastructure sector, also a real asset, but with maybe some different drivers and trends happening. And so one of our viewers asks, how are investors differentiating powered land? What's the sentiment with this play? Data centers, battery energy storage systems, solar. Do investors look at these things differently, or are they bundling them together, Maria?
Ooh, that's an interesting question. I guess, first of all, infrastructure is definitely an evolving asset class. And just across our clients, we see a continuous increase in allocation to infra. It comes at the expense of real estate and natural resource allocations, for sure. Infrastructure is certainly an asset class that brings you diversification and exposure to sectors that real estate just doesn't have. Digital is probably an example where you can argue it's data center, real estate, or infra. But for the most part, if you think about bigger trends, electrification, renewables, power. This is kind of where infra resides, and so definitely a very interesting asset class. In terms of the question about powered land, I think it's a tactical opportunity. We see managers in the diversified space buying former campuses, whether it's office, and finding out that hopefully throughout the due diligence, that's the whole reason they bought it, seeing that it can be a great tactical digital conversion type of a play. Or an industrial manager that found a piece of land that could be industrial, but perhaps the highest and best use is digital. So I think it belongs to the strategies. I'm yet to see a powered land only a strategy within real estate managers. There's some select that obviously have de-risked their land and look to aggregate, but that's a bit of a different beast. We'll stop there.
Rich, do you have anything to add on that question?
Great. I have a lot to add, but I'll try to make it relatively concise. So we've been a data center investor since 2006, 2007. So we've been in the business for a very long period of time. When I speak to data center investors right now, I'd say a third of them investing out of the real estate arm, a third of them are investing out of the infrastructure arm, and a third of them are investing out of some combination of real estate and infrastructure combined. So we think data centers can be a lot of different things, but I think the question about powered land is a really interesting one. And I'll answer it this way: we think a third asset class is emerging. That's neither real estate or infrastructure. It's a combination of the two. And we think data center sits at the center of that. Unless you have powered land for a data center, you don't really own anything. You don't have anything. So when we think about building data centers, we're just actually unlocking the value of the land by putting a powered shell on top of it. And so there's fewer and fewer land spots where you can actually reliably power land. So I would answer the question by saying I think a third asset class is emerging where to power the real estate is becoming really, really important. Frankly, I think you're going to see a joke that infrastructure takes all of my cool real estate assets over time. I wouldn't be surprised to see things like senior housing, student housing become infrastructure assets because they're social infrastructure. So I think the question is a really, really important one. You have to be able to power the real estate. And if you can't power the real estate's really not purple.
Maria?
I was just gonna say that one of my clients recently said, Maria, what is not infrastructure today? Because it feels it's such a broadly defined asset class nowadays that social infra is kind of feeling it's real estate, isn't it? Like some infra managers invest in student housing and senior, and I felt just saying like, well, no, leave it for real estate, please. We've done it for longer. But no, I think all what Rich said is definitely is what's happening in the market today.
Um, just seeing, we've got a few more open questions. One of them, and I'm gonna toss it out to you, but I'm not sure quite how to go about this because I think it is maybe a bit a bit of an opinion. Um, but for you, Maria, what would you say the unleveraged returns projected for closed-end funds by risk, core plus, value added, opportunistic, and if leverage, how much leverage on average?
I would,
So.
yeah. No, it's a good question. Most of the funds, when they tell their story and talk about target returns, they talk about them with leverage in mind. So I will quote with leverage in mind, and Rich, please chime in as well. I would say when you think about value add fund, you're probably thinking somewhere between 11 and 13% net to the investor after carry, after all the fund expenses. So that's before tax, but after all of those things I've just mentioned. So I would say 11 to 13, and you would in the value add fund, as I mentioned earlier, you would expect to see some form of income distribution, not on day one, but as assets mature, you would probably expect maybe up to 2% of this 11, 13 being distributed. As you move up to the risk spectrum, opportunistic funds would target 14 plus. If they can generate more than that, that's great. But again, 14 plus is probably what I would say opportunistic nowadays. And leverage between the two, I would say post GFC, all leverage levels have come down. I would say I still see in fund docs sometimes things like we can lever an asset up to 75%, but the fund usually stays within that 60-65% range. It's probably, I would not expect to see more than that at the fund level, but individual assets can go up to 75. And value add probably step down, not 40, but probably in that maybe high 50s, low 60s. So that's your valid opportunistic bucket. And on the core plus, quickly, core is probably 6 to 8. We know that again, Odyssey posted somewhere like in the 7% net rate since inception, and core plus having leverage up to 50% would be in this 8 to 10%. Again, it's all ranges. Hopefully you pick the top quartile and you end up at the higher end of this range. Rich, anything I missed?
A plus. I would have said open-ended core funds are going to be 7% unlevered IRRs over term. The only one thing I would add, which we haven't talked about, is I'm a lot more investors were talking to me about the J curve. J curve is just a wonky term. Basically means how long does it take for your returns to kick in over time. Look, value add and optimistic have longer J curves unless it is a seeded portfolio. I do think in this world where total portfolio approach becomes more important, the J curve and how you mitigate the J curve on open versus closed, core versus value add and optimistic. There's just a lot more conversations about it over the past 3 to 6 months than I was anticipating. But that's just me trying to add a little bit of value to what Maria said, because again, she gets an A plus.
Oh, you're so kind. I would say we didn't talk about secondaries, we didn't talk about co-investments, but I think these are all evolving tools in the LP's toolbox and portfolio managers as a way to improve the outcomes, reduce the gross to net, be more tactical, get that capital drawn on faster. So all bigger topics maybe for next webinars, Loretta.
Yeah, I was actually just queuing up to ask you about secondaries, but we do seem to be getting pretty close to the end of the hour. So maybe we should turn to sort of some final thoughts and takeaways for our audience. Maybe I'll start with you, Maria, and kind of talk about just, what are sort of some of your sort of key thoughts, takeaways, and things that maybe our audience should be keeping in mind about this environment.
Well, of course, I'm a fan of real estate, and in my day-to-day, I spend a fair amount of time talking with our clients and my colleagues as to role of real estate and why this asset class deserves to be a part of the portfolio. So maybe one takeaway is obviously historical performance is never a perfect guide, but if there's still useful pattern to keep and look at the times like GFC and after GFC, real estate has performed very well in years following GFC, years following the disruption. So I hope we're seeing some signs of recovery nowadays. And while you have to be selective, you have to think about manager selection. I hope that we enter the time when you can really seize the opportunity in real estate, given the magnitude of repricing and all other things we've discussed today. So seize your moment, invest in real estate.
So I'm going to make a comment. I promise you, I'm making fun of myself when I say this. I grew up in a real estate family. My dad was a mall manager. Real estate people like to buy everything when it feels really good and sell everything when it feels really bad. But it's a cyclical asset class where you're supposed to do the opposite. You're actually supposed to buy everything when it feels not so good. And the reality is, over the past couple of years, didn't feel so good. So I think there's pretty significant tailwinds behind the commercial real estate market. Everything I see in the public markets is that it's prioritizing stability of earnings and income-driven total returns, both of which equity and debt, public and private, offer. And I think we've forgotten that headline returns are not all that matters, especially when you look at private credit and private equity and loss adjusted returns are starting to come in. I'm not suggesting the bottom's going to fall out in private credit, but usually returns normalize against each other, and as a result, you need to start thinking about how to optimize portfolios. I really believe, to the point Maria was making, we're going to look back in 3, 5, certainly 10 years time and say, hey, commercial real estate was a pretty good diversifier within portfolios. I just forgot it over the past 3 to 5 years because commercial real estate lagged, and oh, lo and behold, now it's reset while everything else hasn't reset. So, long way of saying, yes, I'm a homer. Yes, I believe, like Maria, commercial real estate's a great asset class, but I think it really has a diversification benefit within portfolios that the investor base has forgotten.
Thank you. I think that's a pretty good place to leave it. I'd like to thank our audience for joining us. I would like to thank our panelists and our IRE.IQ Data Services team, especially Nico Pepis and Director Karen Palma, the rest of my colleagues who helped put together this information. As a reminder, all of the data discussed in this program comes from our IRE.IQ database. This webinar will be posted to our website for people to be able to review the recording. In addition, all of the attendees will receive an email with a link sharing the slide presentation, the report, all of the materials, because we do want to make sure that people have access to this. As a reminder, IRE.IQ includes information on organizations, investment programs, and industry contacts. It tracks more than 6,000 global institutional real estate investment programs, more than 1,100 of which are actively in the market now and seeking to raise a combined total of more than $500 billion from institutional investors. Our publication sponsors receive access to IRE.IQ as part of their benefits package, but if you are not a sponsor and you're interested in using IRE.IQ, you can subscribe by clicking on the logo on our website. Our next IRE.IQ fundraising report review will cover this is the first quarter. It will cover second quarter fundraising, and the webinar will take place August 18th. Thank you all for joining us. Thank you, Maria. Thank you, Rich. Thank you, everyone. Have a great rest of your day.
Thank you for hosting us. Pleasure to be here. Thank you. Bye.